Over the last few weeks, the Nigerian stock market wiped out more than 13 trillion naira value in just 1 month. After a blistering 60% rally in the first half of the year, June turned into a bloodbath. Now, many are pointing fingers at the new T+1 settlement system. But is that really the main culprit? Or is something else going on? Today, we're breaking down exactly why the NGX crashed, what FTSE Russell's sudden pause on Nigeria's frontier market upgrade really means, and what to expect in the second half of 2026. So stay with me, everyone, but let's welcome my guest. Dipo Ajayi is head fixed income and vice president at Chapel Hill Denham. Dipo has joined me to shed more light on what's happening in the Nigerian capital market. Dipo, welcome back to The Edge.
Yeah, good evening. Thank you very much, Dr. Okafo, for having me once again today.
All right, everyone, welcome to The Edge. If you are new to this channel, please hit the subscribe button and the notification bell so that you always be notified when new episodes are uploaded. And please like this video and share with your communities. We are here every weekend helping you to make a better understanding of the investment world. All right, so let's get into it. All right, before we talk about why the NGX lost 13 trillion naira in just 1 month, let's get an up-to-date about what's really happening in the second half. So, Deepo, the NGX delivered a strong 47% return in the first half of 2026, but saw roughly about 13 trillion naira wiped off in just June alone. Now that we are now in the second half, we are days into July. How's the market opened so far, and what does the early price action tell us about whether the correction is continuing or is it now stabilizing?
Well, thank you very much. I think I would say that the market is a bit stabilizing as we speak currently. Um, like what you mentioned, we saw more like a very dovish month of June. And with that as a result of several factors. And but coming to the month of July, I was started seeing a bit of stability in the market. And I don't forget that in no time we expect to start seeing H1 results of most companies. And there are a lot of things that actually drive the market. But I think number one is about the financials of most of these organizations. So we should be expecting to see most of these companies actually throwing out their financial for H1 in the next 2-3 weeks. And I guess that's one of the reasons why we're seeing a bit of chart stability in that regard. And at the same time, most of the big names have actually shared a lot of weights. Don't forget, Arade actually climaxed at a point in time very close to 2,200. And here it's they're trading around 1,275, currently correction to around 1,300 levels. So to a lot of people, they feel that most of the big names, they are currently trading more like their support levels. So people are already having the view that there's no other time for them to actually lock in them now. And a lot of people miss the initial rally. And some are thinking that this is another opportunity for them to actually jump into the ship before the ship sail once again. So, and I think that's what's bringing that bit of stability. So it means that even if there's still sellers in the market, they are also complementary buyers waiting to actually uptake most of those volumes.
Okay, so beyond the profit taking that appears to have happened after the May peak, so what specific factors do you think amplified the sharpness of that correction? For example, are we looking at sector rotation? Are we looking at the liquidity events tied to large corporate actions, regulatory overhang? We're still waiting for that July 9th update that the central bank plans to roll out for the holding company structure. So, what specific factors can you attribute the sharp correction to?
Well, you have mentioned the number one on the line, and that is profit taking. If you look at most of those names, they're actually tending to more like a region where a lot of people feels that they need to actually catch in on the upside they have actually enjoyed.
Mhm.
And beyond the profit taking, there's also the funding of the Dangote refinery private placement. So we tend to see some investors actually shedding weight on their existing portfolio, are trying to actually lock in into that that event, and that just settled. The settlement for the trade just happened I think that just 2 Thursdays ago, and maybe that could actually state or further clarify that it could be true, or it could be one of the reasons, because the aftermath, we start seeing a bit of respite in the market. We start seeing a bit of stability in the market, and also I also think that the T+1 settlement also have its effect on the market, and we know what happened at the end of May, when we moved from a T+2 settlement and T+1 settlement. It was a very good idea, but however, and I think that speaking with some of these foreign guys, they are having challenges in terms of actually getting their trade to settle. And a lot of them don't want to actually be named badly in terms of not fulfilling their obligations. Don't forget that the market is about you, your word should be your bond.
Mhm.
So a lot of them are being very careful not to actually go into market where they couldn't fund their obligations. And as a result of them, most of them were actually staying out of the market for some time. So I also think that that's also have its effect on the market. It may not be as much as the other ones we have mentioned, the profit taking, funding, Dangote placement. But I also think it also has a part to play. As we speak currently, if you look at the constituents of the market into the local and foreign participation, the foreign participation in the capital markets is still not up to 20%. So it also means that larger investor in the market still remain the local guys. And
Local guys, yeah.
however, the foreign guys, one way or the other, when you see their hand, it helps the local investors to also move in direction of where they're actually traveling. And I think that that's one of the things that led to, because when most of the local investors are seeing their drawback, of course, a lot of them feels that it's a good time for them to actually exit their position and move into cash. Another thing that we can also mention is that in the month of June, the DMO rescinded their initial circular around the NTB auction. They were supposed to actually offer around 450 billion. And the DMO actually moved it to 1 trillion offer. And at the auction, the DMO actually sold about 1.2 trillion. And what we noticed was the 1 year paper actually jumped by 100 basis points to close at 17.34.
Yeah.
And that means the effective yield is not of 20%. Dr. Okafor, if you can put your money in a 20% investment, so why bother yourself again? Don't forget that this is risk-free investment.
Yeah.
I doubt there's any stock in the market that can give you that level of dividend yield.
Guaranteed
So it
return,
simply
right?
means that you will likely see some investors actually rotate from equity into fixed income to actually enjoy these elevated levels. And beyond that as well, we also noticed that in the bond space as well, where we saw improved supply in terms of on the part of the debt management office, where they actually offer 1.2 trillion on 2 maturities. And at the end of the day, they ended up selling a bit over 1.2 trillion into the market at a yield of north of 18%. 18% on a 12-year
10 year.
bond or 11-year bond.
Yeah.
Of course, we have an idea of what that means to investors. So I think that we started seeing portfolio manager actually reducing their exposure in the equity market to actually move into the fixed income market. And also, when you see the posture of the debt management office and the federal government, it shows a posture of aggression. So when you see the calendar for the third quarter of the year as well, you also depict that. So a lot of people were trying to actually move to cash so as not to be caught unaware. And
Oh,
that's some of the reasons why I feel had led to that drop that we have seen in the markets.
okay, so you just painted a catalog of factors actually that drove that correction that we saw. So we are now early into the second half of the year. We've had a few trading sessions in July with some attempts at stabilization as you painted it. Are you seeing any kind of real improvement in market breadth? Or is activity still heavily concentrated in a few large caps?
Yeah, we are currently seeing a bit of cherry picking in the market. Of course, you will not necessarily see the whole market respond in the
Mhm.
same breadth. And so when you look at names like MTN, names like GT Bank, Zenith Bank, Access Bank, some of them start seeing a bit of interest. I'm sure it is not unexpected because when you see Zenith Bank actually traded as low as well, about 102. And or even close to traded around 100, there about 120, there about. So it means that he has actually presented on an opportunity for some investors that actually missed the initial rally. Don't
Okay.
forget that Zenith Bank traded as high as 140 naira. So it
Yeah.
means that he has actually taken out about 40 naira. And anybody locking in now could actually enjoy that level of upside movement. And we also saw a bit of interest also in Arabia, in Seplat, in also names like MTN, and some of these big names that people know that they have actually heavily shed most of their weight. And for me, I think that, like
So
I mentioned earlier, it's an opportunity for people that actually missed initial rally to actually enter the market once again.
So investors are back cherry picking on the big names. I mean that's to be expected. But let's look at the latest data on inflation, even though that's been a few weeks back. So the headline inflation is currently at 15.93. Don't forget we're trying to diagnose what's really driving this correction. So we've seen that inflation at 15.93 for May, and that's like the third consecutive monthly increase. So, how is this inflation trajectory currently affecting investors' positioning between equities and fixed income assets, particularly in terms of this rotation between risk assets and the fixed income that we talked about? And I think earlier in the week as well, there about S&P upgraded their forecast about the average inflation to be around 16.9 for the full year 2026. So, how is this inflation trajectory playing into whether investors are deciding on equities or fixed income?
Well, if you look at since the month of February, when this crisis started,
Mhm.
we've seen change in the inflation trajectory.
Yeah.
And that's actually changed the direction of travel for the
Yeah.
monetary policy guys.
Mhm.
But the good thing is that the monetary policy guys, they are still very much sure that inflation will actually will see a bit of inflation will decelerate and from maybe the month of July till the end of the year. And their view is premise of the fact that the current prices can actually be pointed to a specific incident. And what is the incident? That is the unrest that we saw in the Middle East, and that actually led to elevated energy price. And if we look at where we are currently now, we have started seeing a bit of respite. And of course, the country, we are expecting more than what we are currently getting because prices of crude oil in the global market has moved to the pre-crisis level. but we
Even
are not
lower.
seeing the yeah,
Even
yeah,
lower.
even lower, yeah.
Yeah.
But we are not seeing the same quantum of movement in the prices at the gas station. I don't know whether it's same thing at your side, but here in Nigeria, currently as of today, per liter of fuel C trades around 8,150 naira at the filling station. And don't forget that at the point in time, before this crisis started, we were actually buying around 850 naira. Of course, we actually got as high as 1,350 naira before coming to where we are currently now. But we still feel that it's just a matter of time. Market will need to recalibrate this and adjust the price further downward. So what this will mean that this will actually reduce the current inflationary pressure. And what it will mean is that we'll likely see a better posture from the monetary policy guys beyond just standing on the fence. And when you look at inflation, like I mentioned, it has actually led to a lot of investors actually sitting very calm on the sideline. Even if you notice what has been happening in the fixed income market, for a long time, market has been a bit quiet because the expectation is that since inflationary pressure is still very much out there, they expect maybe an hawkish tone from the monetary policy guy. What that will mean is that that could further push inflationary interest rates up, which will actually open a better door for them to enter into the market. But now we have even seen another way at which interest rate has gone up, which is aside from the monetary policy guy being very hawkish. So
Mm-hmm.
when you want to just check between which market has actually enjoyed between this period, I would say it's the equity market, because don't forget that. During inflationary pressure, in equity market can still help you hedge that inflation,
Inflation. Yeah.
that loss of value. Because one of the reasons is because most of the names on the exchange can actually still pass the cost to the final consumer. And if you're able to do that, it means that it means that your revenue will go up. If the revenue goes up, your bottom line will print better. And if that happens, it means that investor will likely have a better dividend yield than what they would have gotten. So we've seen a bit of activity, and maybe that also explains the reason why at a point in time the NGX actually printed as high as over 60%
Yeah.
as return at a certain point in H1. So for me, I think is the equity market that's largely enjoying that level of opportunity. But on the fixed income side as well, like I mentioned, in the last 3 weeks, I was seeing a turnaround in market direction, and that's on. That can actually be pinned on what I mentioned around the aggression demonstrated by the debt management office to actually raise funds. That has actually pushed yield up, and that's where we are currently.
All right. So before we, move on from this segment, so in Q1, so recent data says that in Q1, Nigeria attracted about $10.4 billion in total foreign capital flows. And that's up about 84% year on year. And with a vast majority going into portfolio investments, especially money market instruments and bonds. Equities received only around $132 million. So you might have been seeing the argument about whether we should bother so much about foreign investors' participation in the Nigerian equities market. So, what does this break down? What does it tell you? What does it tell us about foreign investors' appetite right now about the Nigerian stock market?
Well, if you like I mentioned earlier, if you remember, I stated clearly that the composition of the market,
Mm-hmm.
when you look at the composition of the market, the foreign investors still they are still very very low. I
Mm-hmm.
mentioned that the participation is not up to 20% of the
Yeah.
market. The market is majorly driven by local investors. But I also mentioned that foreign investors also show market directions because when you see them aggressive in a name, you tend to see local participation actually going up in that name as well. And for the data that was released, it simply showed clearly that most of these guys, they're actually coming to Nigeria for the yield, for the level of return that you can get in Nigerian market. We've seen the central bank always in the market almost every time issuing homo bills, and when you look at effective return on most of these homo bills, they are not of 20%. And there was a report released by World Bank. I don't know whether I can't remember vividly whether it was World Bank or IMF
Mhm.
around the true value of naira. It was mentioned that the true value of naira should be around 8,100 and something. So it means that currently the currency is currently trading at a huge premium. So it means that so for an investor, a foreign investor, it simply means that they can actually take a bet on Nigeria. So the expectation is that the currency, which is naira, is heavily undervalued. And when you look at something we call carry trade, it brings a great opportunity for anybody trying to play more like that carry trade game. You are in the United States, you can actually borrow maybe around 5%. You can invest in Nigeria where you can get a 20%, and you can have 15% sitting on your table. And the only thing that would have happened would have been exchange rate risk. But if the expectation is that naira will be stable, it means that you can still walk away with 1,500 basis points on such transaction. And that's one of the reasons why you keep seeing most of these foreign investors coming into the fixed income market, coming into the OMO market, coming into treasury bills market, because there's this level of predictability in that aspect of the market beyond what's currently happening in the equity market. You know, for equity markets, imagine you putting money in the equity market and maybe you enter Aradel at 1,800, Aradel is trading at 1,300 naira, you have lost around 500 naira on each unit of the stock. That gives you an idea of what the level of risk that they are currently actually staying out of. But when you look at the way they are playing their game, they are basically just playing game in more like the OMO window, are playing game in the in the treasury bill window. Also, they
Okay.
also play game in the bond side as well, because that one you can also determine what the cash flow will be, and I think that's one of the reasons why we're seeing that level of volume going out to that segment of the market.
Yeah, I mean, I read that report that it was the IMF saying that naira is currently about 26% undervalued. That I mean that it's trading way you know, it's supposed to be trading around 100, 1,130 to about 1,142 naira to a dollar. So, which means the currency still has an opportunity to appreciate down to about that level. So I think there is a video on the channel if you want to, you know, a deeper context about that. Please check that video on the channel. All right. So in the next segment, we want to talk about the FTSE pause and why the whole noise about the FTSE pause. FTSE is saying they're going to pause their reclassification of Nigeria to the frontier market status, which originally was scheduled for September 24th, but that's now undergoing, a check by FTSE because of what they are talking about in post trade infrastructure concerns. Right, so stick with us. All right, so let's continue our conversation, and I'm still being joined by Dipo Ajay. Dipo Ajay is head fixed income and vice president at Chapel Hill. Dipo, thanks for still staying on.
Thank you very much, Dr. Okafor, for still having me around.
Okay, so before we talk about, let's look at what FTSE. So FTSE Russell is one of the world's largest index providers and managers. They they have indices that track over $20 trillion in assets globally. So Nigeria was on track to rejoin the Frontier Market Index in September. And that move would normally trigger funds from passive funds and ETFs. Nigeria was initially removed from the that index in 2023 due to FX repatriation issues. And we're now going to be reclassified and brought back in September of 2026. But FTSE is saying there's a T+1 settlement issue. They want a better understanding of the post-trade ecosystem, post-trade infrastructure available, and they are going to understudy that and come back with a decision on whether they would go forward with reclassifying Nigeria by the end of August. So we have about 60 days, so they're about to wait for their final decision. So that's the context. So the FTSE recently now placed the planned return to the frontier market status under further review shortly after the country moved from T+1 settlements to on June 1st. So can you briefly explain, what happened and why that decision has sparked so much debate in the market?
Well, thank you very much. I think this was more like a blind spot, and that's what I think it is. Because I remember during the implementation of this new settlement window, we had a bit of discussion with some of those foreign guys, and some of them are very much concerned, like I mentioned earlier on, about having their trade failed. Some of them will even just call us and actually just ask just randomly that have we ever seen any trade fails? And one of the reasons why they keep saying this is because of the stress to actually get their trade settled. And don't forget, before we actually moved to a T+1 settlement, we actually moved the trading hours also to 4 p.m. So it means that 4 p.m. in Nigeria, sometimes in South Africa, is already 5 p.m. And most of them are already winding down. So it means that whatever trade you consummate for them, by the time you send out the contract note, some of them may have actually shut down the business for that particular day, and the trade has to settle the next day. So it means that the fund must be waiting for settlement by the next day, and most of their local custodians too will also they actually want to see cash before they actually present their trade to the market. And so I think because trade now closed 4 p.m., which actually limits or reduced the window of actually getting their contract notes across to them. And that's one way or the other has affected them from actually being able to actually fund for that trading day. So now, if you cannot fund on the day of trading, then it means that you are funding the next day. If you are funding on the settlement date, don't forget that these people don't spend naira. They need to send USD, and this USD will need to be sold in the on the FM window. And immediately that is done, it will be converted to cash, which will now go to their custodian, and their custodian, in the same vein, will actually now present the trade to the market for settlement. And I think the cutoff mark time for settlement is 12 p.m. 12 p.m. And most custodians, they want the trades to have been confirmed to them and catch sitting with them latest by 9 a.m. For them to be able to actually collate your trade and push it into the market. So when you look at that short window, one way or the other, that brought a bit of constraint to most of these guys. Sometimes people will say, but why can't you actually send money when you know you are going to trade? So most of these guys don't know they will trade. There are times you just get a call from a client, maybe a client to a global broker, and the guy is just getting instruction for a client, buy me Zenith. And maybe sometimes they even trade at a close rate. It means that they want your price to be the closing price for that particular day. So it means that if you are trading on a closing price, then you will need to fund. How do you fund such trade? And these are some of the constraints that most of these foreign guys are actually seeing, and that's one of the reasons why most of them actually stayed out of the market. But on the sell side, it's not been very difficult for them to do that. Because for the sell side, it's just to give instruction to their local custodian that they should unblock the trade and allow the volume to go into the market. And immediately that is done, it goes to cash, and then the custodian on their part convert the cash to USD and repatriate the fund to them.
Okay, so the capital market community is saying, or they are arguing that the broader reforms in FX and infrastructure are being overlooked, which is like the market has the operational efficiency, the capacity, and we've seen the upgrade in the market capacity or the operational or the ecosystem for post-trade transactions that the market can actually handle that. Now, for foreign investors or foreign institutional investors, the equity cycle that has moved from T+1, but the chain, if you look at the full chain, like if you have from NAFEX, FS conversion, custodian reconciliation, and maybe cross-border repatriation, those ones have not accelerated at the same pace that we have moved from T+3 to T+2, T+2 to T+1, move closing of markets from about 2 to 4 p.m. So they're saying that cross-border repatriation has not, and maybe custodian reconciliation, these ones have not accelerated at that same pace. So can you like paint a picture, as a marketplace, can you paint a picture of how the settlement cycle mismatch, how it currently creates that friction that we are talking about, especially when you look at offshore funds when they want to sell their Nigerian shares?
Well, if you want to look at it from the aspect of other infrastructure, I don't think there's any way you can get those infrastructure to move very fast beyond where they're currently moving.
Okay.
You're talking about actually transferring funds. You and I know transferring money globally. Sometimes you don't get to see it just immediate.
Mm-hmm.
And even if you ended up seeing it just the day of trading,
Yeah.
sometimes the market would have closed by the time the money hits your account. And don't forget, you also need to sell these FX at the MFM window. So it means that you still need to go into the FX market to go and dispose of the FX convert to Naira. Before actually being able to actually consummate the trade and or settle your trade. I think on the sales side, there's no issue on the sales side because on the sales side, they are not bothered about how far or how fast or how slow they get their funds because at a T+2 time, it means that when you compare that to a T+1 time for the sell side, it means that they will get their money faster than they used to get their money. And I think their concern is more on the buy side. On the buy side is when you need to fund because when you are selling something, it means that you are the one that you're expecting cash. So
Yeah,
that
cash,
one is not, there's nothing, they are not actually frowning at anything in that regard. But their concern mostly is around the fact that I don't want to fail my trade. I don't want it to be that one way or the other we move cash and the funding get there on time. And at the point in time, our local custodian is saying that they couldn't fund our trade because of so. Then you are now actually exposing your broker into, you understand, that level of risk. And I think these are some of the things that most of these guys are actually concerned about. When you look at most of the names on these, most of the countries that are actually being covered under this index, you find out that beyond United States and maybe one other country. I doubt there's any other country that's currently doing a T+1 settlement. You have names like Brazil, China, Chile, Egypt, Saudi Arabia, UAE. You have South Africa. You have most of these big names that are actually operating even in more developed markets are still doing more like a T+2 settlement or a T+3 settlement. It's a
Yeah.
lofty thing that Nigeria wants to actually move quickly into that phase. And just like what we said, we don't have that structure to actually move very fast. Because simply means that don't forget that this is not a dollar for dollar transaction. This is a dollar for naira transaction. So
Yeah.
it means that it still needs to go into conversion. If it's a dollar for dollar transaction, I don't think there should be any issue. So it simply means that immediately the money hits your account, then immediately you are good to actually go. And one of the things that FTSE is saying is that they are trying to avoid the situation whereby you need to pre-fund in a
Yes.
market before you can trade, and truly, and I understand as well that as well, because it may not be very good for most of these passive investors. Nobody wants to leave their fund idle. You understand me? And
Then
if
you
I
can
have you on
enjoy
my
some
index,
float on it.
yeah, and you're happy on my index, but yet you are not enjoying that level of patronage. I can as well just leave you in separate classification that where you are currently sitting. And I guess
Okay.
that's one of the reasons why FTSE is actually coming to actually mention that they are currently going to place their hold while they are going to review the issue index.
Yeah, I mean, the question is whether Nigeria is innovating too fast, right? And whether we have the capacity to take on the innovation, right? Because global, if you take an average of global custodians and prime brokers, they are still largely structured around T+2 timelines. The big economies in Europe, talk about Germany, talk about the United Kingdom, they're still structured around T+2 timelines, and they are not considering switching until October, the October now of 2027. That's when they are planning to switch to T+1 settlement. So the question would be, what would it realistically take in terms of maybe regulatory changes, technology, or market infrastructure, or whether we rescind our decision actually and move back to T+2, what would it realistically take for Nigeria to make the T+1 fully workable for large foreign institutional investors within the next 2 months to to assure FTSE that we are ready?
Well, for me, I think that what quickly comes to mind now is that for us to actually rescind that decision, go back to drawing board, rework the situation, improve the infrastructure. Then, if then time comes when we know that we are ready, we can relaunch this. Because, like I mentioned, we are not trading dollars for dollars; we are trading dollars for naira. So it simply means that you still need to go through the window of moving fund. The fund gets to you. You have an idea of how sometimes difficult you move on. The fund does not get to your account. Maybe for another 72 hours. Sometimes you need a tracking details to track the fund. Some of these things are still out there happening, and so one way or the other, that can actually impede or affect the settlement of transactions. So I think having a T+2 timeline, what it would do to you is it gives you a whole 24 hours to sort all the mess. I give you 24 hours to actually ensure the funds in your account. It gives you 24 hours to ensure that the fund has been converted from USD or from whatever currency is coming to into the expected naira. And so he also gives the custodian the right to actually sit on naira so as to be able to actually meet the obligations. Like I mentioned, it was a lofty one because when you see the way market has moved over time, we moved from T+3 to T+2. We moved from 2:30 closing trading time to about 4
4
p.m.
p.m.
And so when you look at the way we are traveling, I think we're actually traveling too fast. And is it wrong to travel too fast? Well, it's not wrong, but you have to ensure that you're actually having a very good tire and your brake is actually working very well. And I think this is where we need to actually match the brake to actually ensure that we look at it again, we reassess the situation, and we take the right decision.
So, what signals from regulatory authorities or the NGX in the coming weeks would give you like the most confidence that the reclassification can still happen in September?
Well, I think what I would have been expecting from the management or the regulator is to
Mm-hmm.
just release news that we are currently engaging FTSE to clarify on our stand why we actually told that line. To also actually explain to them some of the infrastructure we have put in place to ensure that most of the foreign guys are not shut out of the market. And
Mm-hmm.
also, then they could actually not get a feedback from FTSE. Then both of them now reach a conclusion on the best way that they feel that the market will actually travel as to speak currently. And for me, I don't think it's a bad one for you to want to do T+1 if it's more like a fully localized market. If the market where all you are not expecting foreign investors is the Nigerian markets, of course. We want to buy today and get the security tomorrow. You want to sell today and see and ensure that the cash is sitting in your account tomorrow. And one way or the other, this has actually tested our payment system and also confirmed that Nigeria currently have one of best payment system in the world.
Sure.
But the part of the problem is that if it is only local, it would have been very good. But in a situation whereby there will need to be a handshake between your own payment system and to receive FX from an offshore bank and convert it to Naira and move it to a custodian to ensure that trade settles. And this has to happen under 24 hours. And I think that's where the challenges arise. And that's one of the reasons why I would expect the regulator to actually mention around speaking to FTSE, trying to clarify and maybe let them see in a better light what they are doing and what they think that they can do. Because don't forget, just what I said, I'm rescinding decision is just my own opinion. It's not the regulator opinion.
For
The
sure.
regulator can actually throw another line and say, okay, these are some of the things we are putting in place. This is what we have done, or these are discussions we have had with the custodian, this whatever we are putting in place to ensure that they actually are able to actually trade in the market without actually pre-funding. If they're able to do some of those things and they are able to convince FTSE in that regard, of course, we will actually love to continue trade on T+1. But if we feel that this will actually limit the participation in the market, I think there's nothing wrong with actually going back to the standard settlement time.
I think I agree with you. If we decide, or the regulatory agencies decide to rescind their decision, it will only say one thing: it was not properly thought through. It will mean that relevant stakeholders were not consulted, and we just went ahead. The market just went ahead to implement the T+1 settlement without taking a holistic view of the implications of moving from a T+2 settlement in less than 6 months actually to a T+1 settlement. All right, Deepo, thank you for that. Let's now look at the second half of the year and what the outlook will tell us. So with FTSE reviewing their decision or they will come back to us at the end of August, telling us whether they're going to be moving ahead or not. So, how much of a sentiment and flow swing do you expect this single event to be for the market in the second half of the year? Do you expect this to be a driving factor for the market for the second half of the year?
Well, like I mentioned, second half of the year would have been this would have been one of the driving factors for the second half of the year.
Mm-hmm.
Don't forget that the implementation was expected to actually happen in the month of September.
Mm-hmm.
So the market's already factoring that and also expecting what will be the aftermath participation of foreign guys in the market on the back of that. But when you now look at where we are currently, of course, you would think that, okay, do we have any other thing that can actually support that level of activity in the market? I would say
Okay.
currently the markets is currently heavily underpriced on most names. And you see have names like MTN trading around 740, 750 levels. And even you have Aradel trading 1,300 levels. And when you see the result of most of these companies, I'm sure you saw the result of Aradel for Q1. It
Yeah.
was a very good result. And
Mm-hmm.
we saw the Q1 result of Zenith, of MTN as well. You saw the result of Airtel as well. Most of these companies, they actually shown at a very good Q1 result. And also the expectation is that they will also replicate that, even do better in Q2. And you know what this will mean to the market. So it means that they will likely be selling dividends in some of these names. And this will actually spur activity for people looking for cash flow, dividend cash flow from most of these names. So we expect that to be one of the catalysts that will actually drive the market. And like I said earlier on, you don't necessarily need to wait until August, where you hear from FTSE to actually get a market to actually trade in line with that. All we need, market needs to hear is a forward guidance from the regulator that we are currently in discussion with FTSE, trying to iron out some of the areas where we have different view, and also trying to actually correct the teaching program that the market's currently having as a result of the T+1 settlement. And when the market hears words like this, it actually kindle hope in the market. The market can actually trade as if normally this will actually come to pass in the month of September. And I think these are some of the things that I feel also could actually drive market activity. And also, inflationary pressure is as well as another factor. We expect inflation to start actually toning down. And currently, like I mentioned to you, energy prices dropping. We expect to start seeing impact of that on the prices of goods and services. So it simply means that we will likely see inflation being decelerated. And as a result of that, what it means that we will start hearing more like a dovish stand from the monetary policy guys. And if that is you start hearing, imagine the monetary policy guys sitting later in this month are giving market more like a forward guidance that we may likely see a rate cut this year. You have an idea of what that will mean to the market. So it means that on the fixed income space, yield will likely drop, and on the equity space, you will likely see many more portfolio investors rotating into equities. These are some of the things that are more like the catalysts that I feel could actually see drive markets in the H2.
Oh yeah, that. Thank you for that. You actually, because I was going to ask you what's your view, what's your expectation of the MPC that will be taking place in a few weeks. You expect that they will, give the market some forward guidance on the possibility of a rate cut,
Yeah.
and
Yeah, for the month of I think for the month of July we'll
yeah,
see more like a hold.
okay,
The monetary policy guys will not be very dovish, and if you see if you have been following them, you know that they are not currently hawkish,
mm-hmm.
and although you keep seeing them every week coming to the market to actually mop liquidity in the market, but don't forget that we've been having an average of over 3.5 trillion sitting in the market on a daily basis since the beginning of the year. So it tells you that they are not extremely hawkish. You also give you a hand that they are just waiting for the time to actually let loose fully. And so I think that when they start seeing inflations for the month of July, we expect them to maintain. We expect to hear some level of fall guidance. If you remember in the month of May, and I think it was that point where I noticed that the monetary policy actually trivialized the current inflationary pressure that we are
Mm-hmm.
currently facing. They
Yeah.
made it sound that it's just a flash in the pan. So it's not something that is sustainable. And on the back of that, they feel that they cannot make hawkish decision on the back of that. And now that the crisis is already going quiet, and also we are starting seeing oil prices correcting itself. So I think this is a time where you feel that they will demonstrate that level of dovishness by actually giving us more like a full guidance on how they will actually act the remainder of the year. Of course, the month of September could be maybe too early, but I think it will not be a surprise. But it will not be surprising if you actually get a rate cut by the month of November.
So yeah, talk to us about the fixed income market. What's been happening there? Yields climbed to about 19%. Seems some normalcy is returning to that market.
Wow. And I think that's another interesting market. Market has been very flat since February. in February 28 when this crisis started. It was flat on the back of the inflationary pressure that we saw. We saw yield move to 16% range. For a long time, market was trading around 16.5, and that's like I mentioned to you when we start seeing that aggression being demonstrated by the debt management office and the federal government, and the market readjusted in that line as well. And rates went up. We saw what happened at the last NTB auction, where rates closed around 1734. And also, we saw what happened at the last bond auction, where rates actually closed at 1834 and 1835, respectively. That's on the 2035 and 2037 maturity. When you look at that, it also shows you that market is still on the upside, and that post auction, where rates closed around 1834 levels. What happened? The debt management office released the calendar for the Q3, where they'll be borrowing an average of about 1.55 trillion in the month of July, 1.4 trillion in the month of August, 1.4 trillion in the month of September. This is huge aggression demonstrated by the debt management office, and markets actually readjusted rates in that light. And what happened? We saw rate actually tend towards 19%, but before actually hitting the 19%, we started seeing interest from foreign investors actually coming to the market to most some of the securities around 1890, 1895. And now rates actually reversed down to around 1840, 1850 levels by the close of the week. Even some names are already trading around 1825, 1830 as well. And most of these instruments that we are seeing, that's more like what's happening in the belly of the curve. When you look at the long end of the curve, we've not seen that's a huge aggression in movement. We've seen the 53 only move from around 15% to around 15.3, 15.35 levels. That's just 35 basis points. And why the belly of the curve, instrument trading at the belly of the curve, has moved from the month of September today, has moved close to about 300 basis points. So it tells you that currently the volatility is seen in the belly of the curve. And the long end of the curve is still very static. Why? Because there's dearth of supply of security at that segment of the market. Most of the supply we are seeing more like in the short end and in the belly of the curve. And so I think that this is where market will continue to trade. Insurance company, pension fund, they will continue to actually chase instrument at the long end of the curve. And why? Because most of them are doing purely ALM, asset liability matching.
Okay.
So what are they doing? They look at the asset, they look at the liability, they match it out. Oh, I have an asset I have a liability of a 20-year, then I'm looking for a security of 20 years, then I'll match it out. Then so what they are trying to do is to ensure completely matching out. And with that, imagine you having a liability of like around 12%, and you can get a 15.3% long end. Then you just match it out, then you are just enjoying about 330 basis points free on that instrument over the life of the instrument. And I think that's what's happening. And we will not likely see any change this year in that regard, because for you to see change, it means that we have to see the DMO supply more instruments into that end of the curve. And what are the instruments? Do you think that DMO will come to the market now and come and issue a 30-year bond at 18 levels? I think it's suicidal. Because if you are trying to manage the cost of borrowing, you would not actually operate in that direction.
All right. Thank you so much, Deepo. I think one of the things we'll be looking at for this coming week is that CBN's guidance on the holdco structure, and we'll have to see how that impacts the market going forward. The fixed income market, yields went up about 19% or thereabout before, now slowing down to 18.4, as you said there. So Deepo, in closing, I don't know if you have a few words for our viewers who probably are invested in the Nigerian capital market, in the Nigerian equities market. Some are sitting on buses. Some are looking at whether this is a good time to begin to cherry pick. What do you have to tell them?
Well, like I mentioned, equity market is not a short-term investment. It's not an investment where you invest today, you want to reap tomorrow. Sometimes it will look as if but actually lost again. Imagine you have invested in another there at 8,000 naira, it got to 2,000, you didn't sell, now it's back at 8,300, and you feel the wow, I've lost 700. It's not that short run. Equity market is not a sprint, it's a marathon. It's investing for that long haul. Do your foundation, do your analysis, ensure that you are investing in the right name. And I tell you, when you look back in the next 3 years, you'll feel that wow, great I didn't sell. I've said something in the past. 4 years ago, Seplat was trading 900 naira. I bought Seplat. I sold Seplat at 1,300. Here is Seplat now currently trading 10,000 naira. So what do you think? And then I'm sure price went up at the time, and that's exactly what happened. When they actually price went up, NNPC when NNPC came out on the issue of the acquisition of Mobile, and the NFCs came out on it and said, oh, they are nobody's supposed to give them first right of refusal. As a result of that, they are not approving that. What do we see? Market reacted. Market sold down Seplat. But after man, when you look at it now, Seplat has recovered. The event has fully passed. That transaction has been signed, and here is Seplat, where Seplat is trading. Just to actually encourage you, investment in equity market is not a day investment. We've seen FBN trade as high as 15 naira. We've seen FBN go down to 3 naira 90 kobo. We've seen FBN back at 60 naira.
70.
So it gives
Yeah.
you an idea of that, how market trades. Just know that when you are trading, you are not gambling. Ensure that you're investing in the right name and you are putting your money in quality name. And I'm sure in years to come, you will actually look back and feel that you have actually made the right decision. And for some people that are out there that are looking at, is it a good time for me to actually buy? I'm telling you, you need to get on the bus very fast. You need to get on the bus very fast. Market does not wait for anybody. By the time you just look, the next thing you see that most of these names, they will gain momentum. Don't forget that I mentioned that we'll be expecting the half year result for most of these names. Immediately you start seeing most of these results actually shown up by most of these companies, you may end up not get the opportunity to get to buy, because what will you see? You start seeing full bid on a daily basis until when you look back and feel that wow, will it be worthwhile for me to now lock in at this time? So I think that there's no other time for you to buy than now. Most of these names are names that actually produce very good results in Q1, and I'm sure they will actually replicate that in Q2. Thanks.
All right, everyone, that's all we have to offer today. Deepo, it's been a pleasure listening to you. Thank you for your brilliant and insightful analysis, as always.
Thank you very much, Dr. Okafor. It's always a pleasure to be on your show.
All right, thank you everyone for joining us this week. If you enjoyed, if you like this episode, please like the video, hit the subscribe button. If you're new to this channel, hit the notification bell as well, and don't forget to share with your communities. We'll come again next week, and take care, everyone. We're out. Bye.